Hello, everyone. Thanks for joining the AltExchange podcast. This is Chris Myers, your host, and welcome to the show. For those of you joining us for the first time, just as a reminder, in this show, we focus on all things alternative investment related. We want to talk about the current trends, the most interesting facets of this fast growing and always dynamic industry, and of course, most importantly, talk to some of the leading minds in the space. And today we have just one of those leading minds with us. I'm really pleased to introduce John Crouch. John is the founder of Durhamhill Capital, one of the leaders in the multifamily real estate industry. And John is going to talk to us about what's going on in the space, introduce himself, and hopefully shed a little bit of light on what alternative investors can look for and should be looking for in this ever evolving market. John, thanks for joining us today.
Thank you, Chris. I appreciate you having me on.
Oh, it's our pleasure. So, John, if you wouldn't mind, tell us a little bit about yourself and maybe your experience thus far with Durhamhill Capital.
Certainly. I started my career in New York City, specifically working in the tax field. I did a lot of cross-border transactions, specifically modeling out the tax consequences of those cross-border transactions. Got interested in real estate and really started buying and acquiring multifamily assets for my own personal wealth strategy. Um, at the time, I was working for a real estate developer here in Nashville, Tennessee. Um, and I found myself talking to a lot of high net worth individuals, people that were interested in the real estate space, but didn't have the time or inclination to do it themselves. So the more and more I was talking about my personal investment vehicles, I was hearing of more and more people asking to come alongside to invest with us and be a part of these deals and have some exposure in the real estate market. So it just made a lot of sense to me that, as I continued to prove out my thesis and what I believe to be the case in the multifamily asset class, that I would start scaling up with other investors. And that's kind of how Durhamhill was born. And we started off syndicating deals and pooling together private investors' funds so that we could go out and enjoy the economies of scale that are present in multifamily.
That's fantastic. And how would you describe your overall investment thesis?
Sure. So it's pretty simple. I wish I could say that it was extremely profound, but at the end of the day, we're looking to find um, very solid assets in emerging markets, growing markets, that we can deploy our capital and buy real hard assets that can kind of stand the test of time. And we look to acquire assets that are not only cash flowing based on current financials, but we look for opportunity, and that can be in injecting more capital to improve the property, increase rents, and increase the bottom line NOI numbers, or it can be coming in with a little bit more strategic managerial value add that we can add value and increase the building's intrinsic value by improving the operation. So there's several different avenues. At the end of the day, it's really just digging into the asset class and understanding what makes a good deal, and then looking to provide four key tenets for our investors. Certainly, there's cash flow. We want an asset to cash flow throughout the life of our hold. But there's also other avenues that we can build wealth, and that's tax strategies, depreciation, allow us to pass those on to our investors, future value appreciation, and then we're allowing other people to pay down our debts as we hold these assets. So there's a lot of ways that we can add value simply by having a long-term approach to real estate investing.
In terms of the affordability factor that you look for, are you looking for more luxury type properties or maybe more generally affordable type properties or maybe a mixture of both?
Sure. No, I definitely think that there's something to be said about having a mixture of both. Again, I'm not trying to be too strict in my criteria of what kind of deals we're looking for. We're looking for opportunities. A lot of times those opportunities come in workforce housing, even low-income housing
Hmm.
aspects that we can go in and improve those properties. But at the same time, when COVID hit last year in the spring, there were just some good opportunities on the market, and we were able to acquire Class A deals in great markets that I would have never thought that our return profile would have been able to achieve. But because of the market, because of the opportunity, we were able to buy those assets, and they're performing very well to this day.
That brings up a really great point. Can you expand on how the COVID-19 pandemic that it appears as of recording this that we're certainly on the downward slide from, or we're exiting, but how has the pandemic impacted the multifamily sector and your portfolio really in general?
Yeah, that's a good question. Certainly, I hope that we are on the upward swing. It's been an interesting time for so many people, but specifically in the real estate sector. We weren't sure in the beginning. I mean, obviously, when we were buying workforce housing, one of our big pushes and one of our selling points was that workforce housing, Class B, Class C multifamily, is somewhat not recession proof, but certainly somewhat recession resilient. Because
Mhm.
if we went through a recession similar to 08, 09, um, you might lose tenants. You might have some tenants that struggle, lose their jobs, but at the same time, there are people that are living in Class A luxury condos that are also struggling, that are going to perhaps lose their jobs, and they might fall into your asset class. So there was a piece where we felt like in the Class B, Class C space that we were kind of in the middle to where if a recession hit, yes, we were going to have some pain, but we we're also going to pick up some more tenants and things would move on. Um, COVID presented a different type of recession, one that, of course, we didn't foresee, but it put us in a position where there was no trickle down effect happening because no one was really moving out of those units. So it did create a lot of new problems that we had to try and fix. I think, looking back before COVID, obviously long-term tenants and long-term leases were what you wanted. But when COVID hit, and we can talk about this a little bit more, we decided that there was a benefit to be having short-term leases for some of our tenants because the COVID eviction laws allowed it very difficult to get non-paying tenants out of those units. But if their leases were shorter, then we weren't evicting them for non-payment. We were evicting them for just possession of our property. And so there were a lot of little tricks and triggers that we could have pulled to kind of help us cope through that. But to answer your question, I think one of the biggest struggles that we had was just not having a line of sight of what the future was going to look like.
Yeah.
Normal rules of thumb of how many people stayed, your delinquency percentages were just, across our portfolio were different depending on the asset, depending on the market. So we really had to get in there, work with our property management teams to make sure that we were staying ahead of a lot of the problems that our tenants were facing. Because at the end of the day, we're not just there to run a property. We're there to provide a home for people that have their own problems and have their own struggles. So we really wanted to help them find the resources for those that were really trying, that they could find all the great governmental state-run agencies that were helping tenants stay in their units. So it was certainly struggling. It was a struggle to keep that moving, but we saw some properties that had a severe delinquency percentage where we might have been 95% occupied, but only 75% of them were paying, and there was nothing we could
Mm.
really do to evict those tenants to get people that could pay to come into those units. Other properties, we didn't have anyone that just didn't pay, but they would just skip in the middle of the night, and that created its own rash of problems where we were finding vacant units as we were doing normal walks around the property. So there was a handful of issues that certainly uh, hit some of our properties, but by and large, we were able to work with our tenants to find those governmental agencies that were willing to help, and played middleman in the sense that allowed people to stay in their homes and allowed us to continue operating the property as best we could.
Yeah, it's fascinating, and it's a great point that you bring up that when you're dealing with multifamily as an asset class, it's different than almost any other type of alternative investment segment because you're dealing with something that is deeply personal. You're dealing with people, you're dealing with
Hmm.
families, you're dealing with their homes and their lives. I think we've all been, involved to some extent, either as a tenant or an owner with office space or things like that. And
Hmm.
there's a certain distance there, a certain disconnect that can happen when, look, we all know that things happen, businesses go under, businesses need to expand, and there's that detachment. I think really serves to the benefit of the owner
Mm-hmm.
to a certain extent, or the investor behind it, because it's strictly business, right? It's not
Sure.
personal. But in multifamily, it's incredibly personal.
Mm-hmm.
And I think that you raised an excellent point, and that was actually going to be my next question. Looking at some of these, pauses in evictions, and some of the, I think, well-intentioned policies and laws that were passed to ease the burden on tenants in a time where, I think at this point it's easy in retrospect to look back and see how things played out. But if we look back to, April or May of 2020, it's very easy to forget how uncertain things truly were. We really didn't have a read on the situation.
Mm-hmm.
And so, uh, I think that most people would agree that at least the intention behind some of uh, these steps that were taken were were well intended, right? They were positive, but
Mm-hmm.
they do pose and did pose, I'm sure, really significant challenges for property owners.
Certainly.
And the domino effect that happens, uh, wasn't always really thought through. So, talk to me a little bit about your response, your thought
Mm-hmm.
process that you went through, and you had
Sure.
mentioned some strategies for managing that. I'd love to hear more.
Sure. Yes, I can remember back in March of 2020, I was actually in Charlotte, North Carolina, touring a deal that we were really close to acquiring. Was really excited about this particular property. And I remember being at the airport on our way back and finding out that the NCAA March Madness tournament was canceled.
Hmm.
And that's when, understanding that there was something out there called COVID that was starting to kind of rear its head, that it was real. That was the first time in my experience where I was like, wait a second, this isn't just something that I could catch at an airport or in a different country. This is going to affect the U.S. economy and affect my tenant base very much. So that's when we started to really be aggressive. We one of our first steps was we wrote a letter to our investors, letting them know, listen, to the extent that we have cash and we're going to make cash flow distributions, we're going to push a pause on that right now with the uncertainty that's coming. We want to make sure that we have as much liquidity and cash reserves to carry on any significant prolonged loss of revenue. So
Hmm.
I think, from my perspective, being an operator of multifamily assets, it's not only working with the tenants, their experience, the property managers, but it's also keeping a solid line of sight for our investors so that they understand, where their capital is being protected. Because as much as we want to create as much cash flow and future appreciation, capital preservation is really what I try to hold tightest. So letting our investors know that we're going to hold back on cash flow. We talked to our property management teams and said, listen, to the extent that we have any um, non-emergency maintenance requests, let's hold off on those. Let's really focus on what's truly important for this property. A lot of our properties are value add properties where we have significant renovation budgets. Those all got put on hold. And then it was sort of a wait and see because there were articles being written that a third of tenants weren't going to be able to make their rent, and there's all these uncertainties. And I have a lot of agency financing through Fannie Mae, Freddie Mac, and was paying
Hmm.
close attention to what were there going to be their responses. Was there going to be deferments that we could do with our loans and all of those things. And so the first few months was really a wait and see and really trying to determine what the effect was on our properties. And we slowly started to see tenants not being able to pay. Um, and I think from that perspective, that's when, because it was such an event that was affecting all of us and not just where we lived, but where we worked, how we went out and enjoyed our friends and family, luckily for us, we flipped on that person card, that human card, and really wanted to make sure that our tenants knew that we're not going to do anything drastic right now. Let's all kind of work through this together and figure it out. And there was a lot of months where tenants were coming to us early saying, we've been a good paying tenant for how many months, how many years, but we just can't pay right now. And it was working with them to let them understand that, we're not going to do anything rash. We're going to work through this together, and we're going to help you find your way. And once you kind of started getting into May, June, you started to kind of get a sense of what your tenant profile was that was still at work, was still able to pay, and what percentage of your tenant base was struggling to continue to find work. And then there was all the rounds of stimulus and unemployment benefits that were coming through. So it wasn't your typical cycle, to say the least, in the sense that we weren't just looking to our tenant base. We're also looking to governmental agencies to see what was going to possibly fuel our top line income numbers. Because like you mentioned, it's one thing to tell the tenant population you can't be evicted, you don't have to pay if you can't pay. But I don't necessarily have that ability when it comes to our mortgage payments and it comes to our utility payments. And even going to more detail than that, I mean, we need to have people on site to cover the maintenance, to keep our property safe so that these people do have a good home that is safe and can keep them kind of protected from a number of things. So it was certainly a struggle to kind of digest it all and figure out the best way forward. But luckily, we team up with third-party property management companies that really, tirelessly find out about what's going on in the given localities to make sure that our tenants are well protected from a number of different avenues. And in this case, it was trying to find those tenants the right income sources that they could use to pay their rent and keep our properties moving smoothly.
Now that you have the benefit of retrospect, has your perception or your perspective as an investor, as an owner, changed over the last year
Hmm.
at all? And if so, why?
Yeah, that's a good question. Certainly, yes. I think there's a number of things looking at where we stand right now in the multifamily real estate space compared to where we were. Um, I think from a high level investor perspective, I think that if I look back and, we paused on a lot of acquisitions during the early days of COVID because we were uncertain. And I don't think that was the wrong answer by any means. I think that, with not having a good line of sight moving forward, that's the right move to make. That being said, looking at where pricing is today in the multifamily space to where pricing was even 6, 10, 12 months ago, um, people are dying to get their capital deployed in the real estate sector. But because of the pullbacks that have occurred in hospitality, office, as you mentioned, retail, some of the more harder hit sectors of real estate, the multifamily real estate space has just blown up, where it's very difficult to find deals that can pencil out and meet the returns that I want as an investor, but certainly who my investors and what my investors want in their return profile. So that was certainly one of the big factors that I've seen, is just the shift in pricing um, has grown dramatically through COVID. But I also think that as I look and I underwrite deals, I'm certainly providing more capital reserves, um, rainy day funds for something of this sort. I think that we can never predict if it'll come back, when it'll come back, or what the next thing is. But I certainly learned a lot during COVID that I'm going to reserve for things that some people might not, but I would much rather be in a position of strength when your property's tested, as opposed to try and get into a property at a higher price and lower those reserves because it's just not worth it in the end.
No, I think that's wise. Well, I think we're all probably a little tired of COVID, or at least talking about COVID. So let's
Sure.
shift gears for a second. Uh, if we zoom back for a moment, there seems to be, at least from the outside looking in, a macro trend over the last several years uh, as it pertains to Americans' view of renting. If we think back to, my parents' generation,
Hmm.
your parents' generation, there was this stigma associated with renting or renting culture
Sure.
that, at least to me, and particularly among, I think we're called geriatric millennials, which is an offensive term to me, but
uh-huh.
I think you and I are probably in the same boat.
Uh-huh.
Uh, you know, there seems to be a shift, a pretty dramatic shift away from that stigma. That renting is now not only socially acceptable, it's actually preferable
Hmm.
within certain demographic groups and age groups. What is your take on that? And do you think that as Americans we're shifting away from this ownership culture that has dominated for the last 50 plus years?
Yes, I 100% agree with that. I certainly agree with you. My parents were very much, I think they probably had a house, right out of high school, right out of college. It was very much a set your roots and you kind of forget it. I think that, the ideas of home ownership and that being a very monumental part of your life has certainly been diminished to some degree. I still think it plays a big factor, and it'll always play a factor in a large percentage of the population. But I do agree with you that there's a large portion of our younger generation in the United States that is putting a higher bias on mobility
Hmm.
and opportunity that is taking away from that home ownership perspective. And I might want to go to a new market. I just moved from Nashville, Tennessee to Tampa, Florida for no reason other than let's try something else. Let's see a new city. Let's experience a new way of life. And here I am renting in an apartment complex here. I think that a lot of people are valuing that ability to pick up and move. And that's what I love about investing in the multifamily real estate space is that trend is probably going to continue. It might not be the same every year, the year over year growth, but I do think that the idea of people renting for longer is going to continue and is going to be more robust in the future. So buying into properties now, we can see good solid trends of the demand or the supply being offered in a lot of the markets we look at is being absorbed by the demand in those markets for people that are wanting to move out of where they are now. And when people are transitory, they come in and they rent for a few years and maybe they bounce around to a few different properties or they finally find a home that they buy. But at least that movement across the United States is creating a lot more demand for multifamily apartment communities.
I think that's really interesting, and I've certainly fallen into that category of at least being a little bit more mobile.
Hmm.
I grew up in Phoenix, Arizona, and when I started my first tech company, picked up and moved to Denver, Colorado, and rented. And I think that was met with a little bit of uh, I don't want to say bewilderment, but not far from that, from
No,
my parents and my wife's parents, uh, in terms of, well, why are you doing that? But it's a cultural
certainly.
change, and I think that shift is really interesting. And speaking of Phoenix and that area, one of the things that I've noticed too is that there's been this massive explosion of multifamily development in the Sun Belt,
Hmm.
right? Phoenix and the Phoenix suburbs being a huge, market for this, but really throughout the entire region. What do you think is driving that, and do you think it's going to continue?
Yes. Um, that was certainly our thesis going back to 2010s, 2015 to 2020. And I think that that thesis was one that we did see a migration happening away from the Northeast, the New Yorks, away from the Midwest, the North, Chicago, perhaps even away from the coastal regions.
Hmm.
And it was one that we were seeing that there are a cost of living trade off. I lived in New York City for 8 years. My wife is born and raised in New York City. And I think that when you're there and you're visiting, you're paying to ride the ride of some of these big metropolitan areas. And when people get to experience life in the Sun Belt, the Southeast, they start to realize that there are things that they're giving up to live in those big metropolitan areas. And that's what we were hypothesizing that people are going to start moving here. They're going to start realizing that their dollar goes a little bit further, that the weather's a little bit nicer, that the people are a little bit friendlier sometimes because they have the more space, they have all these things. And so we really built Durhamhill Capital looking at specifically the Southeast and with the thought that people are going to be migrating here. And as people migrate this way, jobs are going to migrate this way. And I think that the COVID experience is doing nothing but amplifying that and speeding that process up. So I think a lot of people that found themselves in a city like New York City, where you might have a small apartment, but you get to experience New York City. You get to get out and you get to rub shoulders with a lot of different people and do a lot of fun things. And that got turned off. A lot of people said, "Wait a second, this isn't working.
Yeah.
I'm going to have to find a new place." And it only makes sense that they come down the coast. They come into the Carolinas. They experience Georgia, Savannah. They get into Florida. They get into Tennessee and Nashville, and that's certainly what we've been eyeing for the past 5 to 10 years. And I think that COVID has ramped that up, and it's allowed us to see our thesis play out on a much faster scale. And we see the population moving, we see the jobs moving, we see the job diversity happening in some cities that used to be a one-trick pony, and now they're not. And that provides a lot of stability for someone like me who wants to buy an asset in a city or metropolitan area that isn't going to be dictated by one industry or one major job producer.
Well, I would argue that you are well ahead of the curve, and that we're really looking at the exponential growth phase right now. Obviously, the response to COVID and restrictions are certainly coming into play in Florida, for example.
Mm-hmm.
But even we're seeing this massive migration from the Bay Area, tech companies moving into Miami, for example.
Mm-hmm.
It seems like not a day goes by that you don't see another VC firm or another startup or another accelerator moving to Southern Florida, again because of cost of living and perhaps a more laissez-faire approach to
Sure.
regulation and that sort of thing, and Texas as well.
Mm-hmm.
Obviously Elon Musk and Starbase and everything happening there. So I think that it sounds like Durhamhill Capital's thesis was really, really well positioned for what's happening now, and that's an exciting thing to
Yeah,
be
certainly.
not only ahead of the curve but well ahead of the curve in that capacity. So, since you've had such a prescient vision of the migration of business and people, what do you think, standing here in the middle of 2021, what do you think the second half of the year and obviously the next few years has in store for us? And I recognize it's a loaded question sitting at the end of a giant black swan event that has
Yeah, yeah.
changed our society forever. But what do you see at
Yeah.
this point shaping the
It
future?
it's definitely very interesting. I think that when I started 2021, I thought that it was going to be um, just an open field of opportunity for deals to be had, um, with maybe the COVID experience shaking some less experienced operators, shaking some people that maybe weren't as capital reserved. Um, and to be honest, with the change in the real estate market as a whole, and people may be shying away from those other sectors that have been hit a little harder than multifamily, again, office, hospitality, even to some extent retail. It's really condensed the open market for new acquisitions. And so it's been really, really challenging in 2021 to find deals that really meet our criteria internally first, because at the end of the day, I started Durhamhill Capital because I wanted to invest in multifamily. It just so happened that I had enough people beside me and alongside me that wanted to do that with me, that we were able to scale to a greater extent. But at the end of the day, I still have my own personal return metrics that I want to hit. And so
Hmm.
as we sit in, starting to get into the second half of 2021, luckily we were able to get two deals accomplished already this year, and we're able to get the pricing from towards the tail end of 2020. So we bought right at those moments, and those deals made a lot of sense. But as I look at deals now, it's just extremely difficult to get them to pencil out, to meet our return metrics. And what I'm finding is a lot of people are acquiring multifamily property with debt that, quite frankly, is over leveraged. It's in a position where I'm looking down the road, and they're putting on bridge financing to acquire the asset, but there's nothing to necessarily bridge to. I don't believe
Hmm.
cap rates are going to get any lower. I don't think we're going to see as high evaluations as we're seeing in the multifamily space. I don't think debt's going to get any cheaper. So it really, I'm taking a pause to some degree. I'm still looking at the market every day. I'm still looking at deals every day, but I'm not trying to force a round peg through a square hole. I think what I'm trying to do is just keep my eye on the market. Luckily, we can be patient, we can be disciplined, and we can wait for those good opportunities. So, the rest of 2021 might be fairly quiet from a Durham Hill Capital perspective. Certainly, deals are trading every day, and kudos to those firms that are able to do so. But I think we're going to wait for our moment. I think if we're really putting ourselves out there as a firm that's looking for good opportunities in the real estate space, now might not be that time. And so what we're doing is we're focusing on our current portfolio. We're keeping our eyes and ears open and reaching out to real estate owners to see if they're interested in selling and seeing if we can broker some good off-market deals that'll allow us to hit the returns that we and our investors are hoping to achieve.
Yeah, I think that makes a lot of sense. I mean, especially nowadays, you're looking at the real estate market across the board. I mean, I have a large commercial building here, office building in downtown Denver that I have on the market, and it's mind blowing the type of offers that I
Yeah.
get or the offers that I don't get. And so saying no to deals is
Hmm.
often some of the best
Yeah.
decisions that you can make
You're
at
exactly
the
right.
time.
It's not as fun and
Well,
it's not as exciting, but I think those are the
no,
things that
no, it's not.
separate a long-term firm from more of a short-term. And I think that's one of the things that I hope that the people that I work with, whether that's on the property level, the investor level, um, that this is a long game for me. This is a long game for Durham Hill Capital, and we hope to be doing this for many, many years. And so there's no reason to rush at any given stage. Let's play the cycle. Let's not get played by the cycle, and let's be patient in the things that we like to do.
Absolutely. Switching gears for a moment, we've talked offline a little bit, but our audience here for this show is incredibly diverse,
Hmm.
right? We've got investors that are really all over the spectrum of alternative investments, from
Sure.
startups to cryptocurrency to
Hmm.
real estate to, you know, everything, and then some. So, one of the questions I always love to ask people is, what is your pitch
Hmm.
for your sector, in this case, multifamily real estate, to an investor who may not have an allocation in their portfolio in this
Hmm.
space right now?
No, that's a good question. Um, certainly real estate is something that everyone, to at least some degree, understands. They see it, they
Hmm.
feel it. They most likely had a transaction in real estate to some degree, whether that's even a lease, to owning a home, to buying a property, to running a business inside of an office building, or something along the like. So I think that comparing it to something like crypto is something that gives me a leg up. I know that the people that I talk to, the investors that are interested, they at least have a general understanding. So then it's filling in the gaps. And I think what I look to do, what my pitch is basically saying that we are looking to partake in the economies of scale that occur in real estate investing. On an individual basis, we may not be able to go out and buy 200, 300 unit apartment communities on our own. But if we, scale together, pool our money together, we're able to have a piece of that large scale institutional asset that are usually reserved for large pension funds and other large equity groups. And we're able to partake in that investment class with a smaller at risk number. And so what we look to do is look for deals that are going to provide your common investor, your private investor, that opportunity to invest alongside more institutional grade investors. And so from there, it changes yearly, but the nuts and bolts of it don't really change that much. We're able to buy a hard asset, one that is, to some degree, a hedge against inflation, because as
Hmm.
the monetary policy creates more flow and more money in the system, obviously as costs go up, so are rents and things like that. So we're going to be able to hedge against that inflation risk. But it also gives our investors the ability to invest in something that they can hold, that's tangible, that they can see. And I think that a lot of times that gets people in the door. And then from that point on, it's really talking about how multifamily has uh, appreciated over the years. And if you kind of zoom back and look at it as a multi-decade holder of real estate, you're going to see appreciation throughout the United States and most markets. And so what we look to do is piggyback off of that and give our investors that comfort that your capital is going to be protected, but you're also going to see some upside growth down the line. And in the interim, we're going to have cash flow distributions that you're going to be able to pocket and move forward. So it's a pretty basic approach. There's not it's not something that's extremely complex, but at the same time, it's something that people understand and want to have an appetite for
Hmm.
in their portfolio.
So if you're talking to someone who, is broadly defined as a high net worth
Hmm.
individual, but maybe under the family office threshold, but certainly accredited and has some money to invest, what percentage of their portfolio do you think should be allocated to multifamily?
Sure. Obviously it changes person to person. There's no one size fits all, but at the same time, I think that real estate has played a very big part of the wealth generation in the United States from the very
Hmm.
beginning. I don't think that's going to change. I think that certainly that's going to be a large piece of the puzzle moving forward. And so, what I look to do is tell people that there's a lot of different avenues that you could start with a firm like ours or any other firm that could go out and give you access to the real estate space. And we want you to be comfortable first. We don't want you to put in anything that's going to hinder your lifestyle or hinder the way that you run your family. But I really think that a real estate has a piece of a high net worth individual's portfolio, anywhere from the 20 to 40%
Hmm.
of what they're investing. And I think that is something that can probably be, tested and looked at as a safe percentage of your, investable net worth portfolio.
I think it makes sense. So my last question for you today is actually something you touched on just moments ago. But we find ourselves in a space as a nation right now where multi-trillion-dollar spending packages are have rapidly become the norm,
Hmm.
and not only the norm, that they just seem to grow exponentially each month. So personally feel it's safe to say that inflation is, if not already here,
Hmm.
right around the corner. How do you feel this is going to impact your sector moving forward?
Yeah, that's it's something that's been kind of burning at me a little bit more lately. I think obviously when inflation is more controlled, and it's something that is trickled out over decades. Um, I think it helps the real estate sector. I think that is one of the selling points is that hard asset brick and mortar is something that's going to be able to appreciate alongside the inflation rate, and rents trend upward because of inflation. So
Hmm.
that is something that has certainly been a piece of the puzzle for our story. That being said, there is something to be cautious of when we start talking about hyperinflation and how cryptocurrencies specifically are looking to pull back on the inflationary growth in the United States. And I think there's a real concern from my perspective that looking out probably longer, much longer term than the immediate future, that when a new cost of capital is kind of set in place, not by monetary policy, but more from a let's take the cryptocurrency worldview. If that becomes the new standard of what is the true working cost of capital, it puts my industry on edge, because right now our valuations are kind of pegged towards where the interest rates are, where is the treasury, where's the 10-year treasury, what can we borrow money at right now, and you build off of a spread, and that's what people are willing to buy into multifamily real estate, to earn that spread over what they can borrow the money to acquire the asset. So when you hear of cryptocurrencies kind of setting a new standard of what that cost of capital could be, that could change valuations in real estate in a very large way. Now, I do think we're talking many decades out in the future,
Right.
um, but it is something to kind of keep our eyes on and make sure that you're not in the cycle when that occurs. So there's certainly a lot of different things that kind of go into that, but um, it's one of those things you just got to keep your eye on and keep paying attention to what cycle you're in, and making sure that you're making the best decisions based on your worldview and what you think the cycle is going to turn into 5, 10, 15 years down the road.
Completely agree. Well, John, thank you so much for your time today. I know you're incredibly busy, so thanks for sharing your insights with me and with our audience. If somebody wants to get a hold of you or learn more about Durham Hill, what's the best way
Sure.
to do that?
Yeah, I appreciate it, Chris. You can check us out at durhamhillcapital.com. You can see our email there, and you can reach out and see what we're up to and get on our calendar, and we can talk more about what Durham Hill Capital is doing and how it might fit into your portfolio. So I really appreciate you having me on today, Chris, and hope you have a great day.
Thanks. I'm sure we'll talk again soon. And thank you all for tuning in today. Be sure to both like and subscribe and keep an eye out for our next episode coming up soon. As always, this has been the AltExchange podcast, and thanks for listening.